In this video, I would like to talk about the biggest risk the market faces. Right now, the stock market is entering a correction. Stocks are mostly down. A lot of stocks are down by 20%, 30%. Some are only down by 5%. And in this video, I want to talk about estimates. What is priced in this market, because if you look at the big tech, the big magnificent seven, they are down a big amount for 2025. We are already in March, but seems like the sentiment has shifted from euphoria and plus 20% performance for sure for this year to extreme fear, where a lot of people are freaking out. And the biggest risk I see in this market is that a lot of good news is already priced in. If I take a look at Microsoft, I'm on FinChat right now. If I look at the estimates of revenue for future years, you can see that they estimate that the revenue will go up by 13% and then 14% for 2026. And then for 2027, they can grow 15%. So things will go smoothly and will grow by 15% on average. If I look at the earnings per share, the EPS, you have 11% growth, 14% growth, 17% growth. If I take a look at, any metric will do the work, right? Free cash flow, you have flat, plus 20%, plus 30%. So obviously, this is a high guidance for future years. And if I look at the PE ratio for Microsoft, the PE ratio is 31. What kind of multiple would you pay for such a reliable business, high free cash flow business that has this kind of growth in the future? Maybe a PE ratio of 25, maybe 30. So all the good news is basically priced in. If I take a look at other businesses, all the good news is already priced in. And the most famous example is Nvidia, right? If you take a look at Nvidia, it's a marvelous company. They have grown a lot in the past. The PE ratio for this business right now, it's around 40 because earnings grew a lot. And if you take a look at the estimates for this business, look at the revenue growth, they expect the business to grow massively, plus 50%, 20%, 20% in future years. For the earnings per share, they expect this business to grow plus 50%, 30%, and then 11%. For the free cash flow, they expect this business to grow 50%, 30%, 13%. Everything is priced in. What kind of multiple to pay for this one? The stock price went up a lot, right? The stock price skyrocketed when this business went from being great to being one of the greatest businesses of the world. So obviously, all the good news starting to be implemented in the price. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Now, maybe it's not enough to justify this high price, this high valuation with a P ratio of 40. Maybe it's not enough to grow 20% per year. Maybe it's not enough to grow 30% per year. Maybe the markets expects more. And if for the next quarter, Nvidia releases a disappointing quarter, the stock will crash. Now, the latest quarter from Nvidia was decent, right? They delivered strong earnings and the guidance was okay. But this was not enough for this market. The stock did not go up anymore. This is not what is surprising in this market. And it seems like this market is very demanding. Yes, the PE ratio for the S&P 500 is around 30, but the PE ratio for these high companies, growth companies, Nvidia, the expectations are much higher. The market is demanding. It's not enough to grow 20%. You need to post a surplus of earnings, surprise earnings. You need to always increase your guidance. And if you don't raise your guidance, the stock will crash. And we saw the same example with Salesforce. Again, great company, one of the leaders, PE ratio of 45. So on the pure PE ratio, this is quite high. And the stock dropped recently because they delivered good earnings, but not that good. earnings only grew like 9%, which is good, fairly good, but they don't deserve a P ratio of 40. If you look at the estimates for this business, same thing, right? You look at the revenue growth, you expect to grow 8%, 9%, 10%. Okay. Is this kind of growth worth a PE ratio of 45? That's a good question. Maybe not. About the earnings per share. Now that we had the latest earnings, all the estimates went down a little bit. They expect the PE ratio to grow 12%, 13%, 14%. For this kind of same growth, Microsoft had a PE ratio of 30, right? And for Salesforce, they have a PE ratio of 45, so 50% higher. Do you think that Salesforce is, has a 50% higher quality business model compared to Microsoft? For me, no. I prefer Microsoft. I love the reliability, but I'm biased. I have never used a product from Salesforce, or not knowingly. So I don't think they deserve such a high P ratio. And to that extent, maybe Salesforce is overvalued because they only grow by 10-15%. And if you have to choose a business that grows 10-15%, come on, choose Microsoft. It's very simple, a simple business model that you can't live without, literally. What about the free cash flow for Salesforce, by the way? Salesforce, you expect the free cash flow to grow 11%, 12%, 12%. Yeah, same stuff. This is a business that grows 10-15%. So why does it have a P ratio of 45? The market expects a beat and a raise. They expect these companies to deliver spectacular earnings, raise guidance. So the biggest risk I see in this market is demanding market with companies that are good but not extremely good. These are not gods of the market. They are doing their best. The CEOs, the management are great, but you reach a point where you can't raise your guidance every year. And if you don't raise your guidance, if you don't surprise Wall Street, your stock will go down. And I see many companies like this with high PE ratio, and they don't raise the guidance anymore. So obviously, for good reasons, the stocks are going down. And if in your portfolio, if you have such companies with high PE ratios, the moment they disappoint investors, the moment they disappoint Wall Street, these stocks can drop 10, 20, 30%. And if enough of these companies are delivering decent results or even disappointing results, it can drag the overall market. It can have an impact on the total S&P 500, the global S&P 500, and it will maybe cause a correction or bear market. The S&P can go down 15%, 20%, not because of bad economic data, just because of a demanding market, high estimates, high guidance. Now the S&P 500 has a P ratio of 28, 29, 30, so it's quite high, quite demanding. In this kind of market, you need to have clear guidance improvement over time. So we will see. Now we have a lot more uncertainties in the market compared to last year. So we will see how 2025 is. And you can have the other scenario where all the big tech companies deliver spectacular earnings, AI implementation, and they raise their guidance. If this is the case, you can expect the market to go up significantly, because it shows that all their investments in AI will have worked. All the capex improvement, capex increase will have worked. So you can expect this. Either demanding market and the stocks will go down to reality, or you can continue to live in fantasy land and expect these businesses to grow forever. My advice is to be cautious. If you find that one of your companies in your portfolio has a high PE ratio, please check the guidance and check if that matches, if that fits. If you have a decent growth expected in the future, you can expect a decent PE ratio, not a PE ratio of 45. This is a 50% premium compared to the overall market. And from my point of view, I don't think they deserve this kind of valuation. So this was an example for Nvidia, Microsoft, Salesforce, but you can have plenty of other examples. I hope this video was helpful. Good luck for you in 2025 if you invest in these high valuation stocks. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.